week. And of course, the title of the podcast, this video, is a little scary, especially for people in the mortgage industry, because it's true. I mean, once again, based on the data that I'm looking at, that's where we're starting. So, of course, mortgage rates have hit a 33-month high, according to Freddie Mac. They do a weekly survey and sort of get an idea of where rates are for the week. Of course, rates fluctuate day to day, all that good stuff. But this just sort of gives you kind of an average of where rates are. And if you've been listening to this broadcast, podcast, whatever it may be, then you know that rates have been moving up. And last week, I think it was a 25-month high. And now we are at a 33-month high. And I do want to remind everyone, and I said this before, and I'm going to keep saying it, is that everybody I know that I follow in real estate, economists, people that write about real estate, journalists, people in the business, whether it's mortgage bankers, whether it's real estate agents, they're all talking about inventory, and everyone outside of real estate is talking about rates. Now, rates matter, but the inventory issue is still the bigger issue, regardless of what is happening with rates. And I still find that very fascinating, because everyone's like, oh no, rates are going up. This is going to devastate. In fact, I saw today on Twitter that one of the Fed presidents, where is Bullard out of? I can't remember where Bullard's out of, but he mentioned, he's been out there. He's very outspoken. he's like the pal's go-to guy, like go out there and make some messaging. And he was saying that, and I have not gotten a chance to see the full clip. I think he was speaking at Columbia, and there was a tweet that was getting a lot of attention, and it said, Bullard said he's worried about housing. And of course, everyone immediately went, oh, here it comes, 2008. It's happening again. Home prices jumped just like they did in 2007. And now here we are. This is going to be our 2008. Home prices are going to collapse once again. Now, of course, what he's talking about is that as rates move up, it's going to push more people out from being able to afford. That's just the reality of the situation. You got home prices moving up and rates moving up. And now the hope is that as rates move up, it's going to start sort of pushing down on this upward pressure with regards to prices. And so prices aren't going to drop, at least I don't think anytime soon. But you will start seeing some of these, 18, 19% year over year climbs every month. That's going to start dropping. At least that's the argument. But it's far, far from 2008. I mean, 2008, if you wanted to get a mortgage, you just needed like a face. Like it was like a face and maybe an ID, maybe. And it was like, here's your loan. It's like, oh, and you want to borrow 100%? Totally. We agree with you. Now, that is not the case. Okay. That is not the case. In fact, as we've talked about many a times here on the broadcast, people are sitting on so much equity that I'm amazed that we're not seeing more cash out refis. What was it? $10 trillion in equity? What was it in 2008? Like $100? Like you were lucky if you had equity in 2008. Now people are sitting on, I think the average is like 100 and some thousand, almost 100,000, somewhere around there. Very different than what was happening in 2008. But yes, I mean, rates going up is going to be sticker shock for a lot of people, especially when we just saw the lowest rates we've ever seen. And so now we're moving back to a sort of normalized situation. So where does Freddie Mac have these rates? Well, the 30-year fixed average rate jumped 23 basis points. That's week over week to 3.92%. That is 111 basis points higher than 1 year ago. The 15-year fixed average rate jumped 22 basis points to 3.15%. This is 94 basis points higher than 1 year ago. Now, this is the highest rate that we have seen since May 30th, 2019, when the average rate was 3.99%. It actually had fallen from the week before. I think it was like 4.06. I spent a little time this morning when these numbers came out. I said, well, I got to go and find when rates were like this so I could figure out exactly how high, 33-month high, what the number was. And I went and saw that the May 23rd, I think it was 4.06. So it actually had fallen to 3.99. Here's something interesting, though. The 15-year at that point was 3.46, which is 31 points higher than where we are right now. Just a little side. Throw that out there. There we go. There's the term. Throw it out there. So this is the highest rate since May 30th, 2019. But remember, that's when rates were falling. So it's so funny that like, everyone's like freaking out, like, oh my gosh, rates, they're moving up. And it's like, guys, it wasn't long ago that this was like normal. This is like a normal rate. So let's calm down, okay? Sam Cater, Freddie Mac's chief economist, noted this is not good news for first-time home buyers, saying, quote, the 30-year fixed rate mortgage is nearing 4%, reaching highs we have not seen since May 2019. As rates and house prices rise, affordability has become a substantial hurdle for potential home buyers, especially as inflation threatens to place a strain on consumer budgets. Now, the Mortgage Bankers Association on Wednesday reported that they had rates already above 4%. But here's what's interesting about the MBA. Their average contract rate was a 30-year fixed, was a whopping, had jumped 22 basis points to 4.05%, but that was only up 107 basis points from a year ago. So they have a higher rate, 4.05, but it was a smaller spread between where we were 1 year ago. And so that's where, you know, mortgage bankers got it at 4.05. Freddie Mac has it at 3.92. And like I said, a lot of people are freaking out, not realizing that, you know, it'd be different if it was like, this is the highest rate we've seen in 33 years. Then I could see some panic. Then I would kind of get that. But 33 months, I mean, let's calm down a little bit. Now, of course, home prices are higher than they were 33 months ago. So I get that. But let's also not forget that, once again, we are sitting on inventory levels that are the lowest that we have ever seen. Ever. Not a 33-month low. Ever. We have never seen inventories this low. And the whole reason why everyone's having this conversation about rates right now is because we're seeing inflation. And the Fed is having this big debate. And of course, we've talked about what the Fed might do. And the 50 basis point number is getting a lot more attention. But when it comes to, you know, what we're talking about with regards to rates and housing prices, the whole idea behind this is to kind of slow things down. And so everyone's freaking out, but are things going to slow with housing? Yeah, but that's what's supposed to happen. That's what we want to happen. As I mentioned earlier, Federal Reserve Bank of St. Louis. I said I didn't know where he was from. St. Louis. President James Bullard said bringing down inflation may require the central bank to overshoot a neutral target interest rate, which he sees at about 2%. Bloomberg reported, once again, this is what he said at Columbia University, if you wanted to put downward pressure on inflation, you'd actually have to get to neutral and go beyond neutral. And I think that's a major concern of mine. We're not really in a position to do that right now, but we have to get into a position to do that in case inflation doesn't moderate as expected. And there was a great tweet, I think it was last week when the CPI numbers came out at 7.5%. And someone said the last time inflation was this high, the Fed's fund rate was 15%. Just to give you an idea of where the Fed, what the Fed might have to do with regards to rates. And once again, is that going to have a slowing effect on housing? Yes. Is that good? Yes. That's the whole point. So it was so funny that Bullard's like, well, yeah, I'm worried about housing. I mean, yeah, he's worried about a slowing. But that's what is supposed to happen. You can't have housing increasing 20% year over year. I mean, that would lead to unaffordable homes unless rates go negative, which people don't realize that actually exists in Europe. They have negative rates. They do. I'm not kidding. I read an article. I think it was the UK, and people were actually getting paid from their mortgage company for having a mortgage. I mean, they're making their principal payment, and then they're getting like a little credit, and that's the negative interest rate. It's crazy. It like shouldn't exist. It's one of those things that you're like, wait, negative interest? What? How does that even exist? It's like stagflation. Like, what do you mean inflation's happening with no growth? How does that happen? That shouldn't exist. It's very bizarre. No, if all things being equal, it shouldn't exist, but it does. It does exist in some places. And so, yeah, unless rates go negative, home prices cannot just continue to move up in perpetuity before they eventually get to the point where people can't afford them. So you need to have slowing in housing, and it's not a horrible thing. I mean, most people buy a house and they're in there, maybe 30 years if they're lucky. But I think what's the average time? 7-8 years, something along those lines. You're in a house for 7-8 years, it's gonna be profitable, right? I think even if you bought it like the peak in like 2008 and then things crashed, if you were there for 8 years, I mean, depending on where you were, you maybe got close to breaking even. I mean, it's like sort of like it's like the opposite of like that whole quote from Fight Club, where they say, long enough timeline, everyone dies. A long enough timeline, the lifespan of everyone drops to 0. On houses, on a long enough timeline, you will profit. On a long enough timeline, you will. But yeah, in the short term, yeah, I mean, are we going to see some fluctuations month to month at some point? Yes, that's the point, though. You can't have houses appreciating 20% every year. It can't. Okay, it's unless wages are also appreciating at 20%, then okay, fine. That's not happening. So that's the whole purpose of all of this. We are supposed to see some slowing in housing, which of course, what does that mean? Well, that means instead of right now, you put a house on the market and you get 10 bids, now you get 4. So it's not like they're acting like you're not going to get any bids. Like you put the house, no one's going to buy a house. No, you're just going to go from 10 bids to 4 bids. So you're still going to have a bidding war even with rates moving up.